Hello, everyone. I want to thank you all for joining us today as we introduce our newly launched Luxor Hashprice derivatives contract. For those of you that have not met us yet, Luxor is a technology company that has built a wide range of solutions for blockchain infrastructure, including a globally distributed mining pool, a hash rate network switching engine, an ASIC management platform, and now hash rate derivatives. My name is Matt Williams. I am a former commodities trader, and prior to joining Luxor, I spent time as director of market structure at CME Group and the managing director of technology strategy at National Futures Association. I now sit as the head of derivatives at Luxor, and my remit here is to bring new derivative instruments to the mining community. Plan to cover several topics today that include defining some key terms around the contract, what are forwards and NDFs, what are the mechanics of our new derivative, and also some tangible examples of how this product can be used. We should have time at the end for Q&A as well, but please feel free to submit your questions in the chat at any time, and I will do my best to answer them as we go. So with that said, let's just kind of dive into the presentation. So what is Hashprice? Hashprice is a term coined by Luxor that quantifies how much a digital miner can expect to earn in revenue from a specific quantity of hash rate. Hash rate being the speed at which a computer can complete an operation in cryptocurrency's code, such as Bitcoin. So in effect, hash price can be thought of as the true value a miner gets paid for the commodity that they have, which in this case is hash rate. Hash price is a function of four main components. The first being block reward, then transaction fees, network difficulty, and then Bitcoin price, with the latter two having the biggest impact on movements in hash price. So the chart you see over here on the right comes from Luxor's hash price index, which is a widely referenced benchmark in this space. The index quantifies the expected return of 1 petahash per second per day of hash rate on the Bitcoin network. This is also the benchmark behind our newly launched derivative. So hash price can be denominated in either BTC or USD, but for the purpose of this new derivatives and this presentation, we'll be speaking in USD denomination. But before we jump into the details of our hash price NDF, I want to give a brief overview of the forward contract as it's known in traditional finance. So a forward contract is one of the most common instruments in the derivatives world. And the modern forward contract dates back to the mid-1800s when farmers would come to Chicago to sell their grains to buyers, and the buyers would in turn ship it all over the world. Now, forward contracts were created as a way for farmers to get better revenue certainty for the crops they were growing and know, before they grew their crops, how much they had to produce and what price they were going to sell it at. So in fact, forwards are used to hedge against price risk of the underlying commodity, which is very similar to the use case we see in the Bitcoin mining community around hash rate. Forward contracts represent the beginning of modern hedging, and the prevalence of these instruments actually led to the creation of the Chicago Board of Trade, which is where I began my career. At its core, a forward contract is simply an agreement between two parties and typically has one of two different outcomes. It could be a physical delivery of a commodity in exchange for a fixed price, or it could be a straight cash settlement where no physical assets are exchanged. Forward contracts, both the physically delivered and cash settled, are widely used and prevalent in pretty much every asset class, be it the agriculture that I just mentioned. They're also very popular in energy, interest rates, cryptocurrency, and other asset classes as well. In a physically delivered forward contract, one party agrees to buy a commodity on a future date at a fixed price, whereas the other party agrees to deliver that commodity at the fixed price and date. And there's some examples of these that exist in the Bitcoin mining space today. However, we're going to explore a different type of forward. So a non-deliverable or cash settled forward contract, which is also called an NDF, is essentially the difference between the fixed price in the contract and the settlement value of the commodity at the time of expiration. And that is typically paid in cash from one party or the other at the end of the contract. So as opposed to the physically delivered forward contract, there's no physical component whatsoever. in an NDF, and the exchange of cash, as I said, usually occurs at the end of the contract, although there are some nuances there. So this is the instrument we chose to launch as our first hash rate derivative. And now I'll go into the mechanics of this Hashprice NDF. Okay, so when trading forward contracts, two parties usually come together, sometimes more, that are often referred to as counterparties, and they have to agree to certain key terms of the deal. So for Luxor's Hashprice NDF, there are three main components that need to be defined in the contract. The first is the price of the trade, which in this case is hash price. So this is defined, as I said before, in petahash per second per day. And I believe the current spot price is roughly $67, or at least it was this morning. And then the minimum price fluctuation for these contracts is down to the penny or the cent. So you could trade 67.01, 67.02, et cetera. The second component that's agreed upon between counterparties is the size of the trade, which is also defined in petahash. So smaller trades could be 10 petahash or less, larger trades could be in excess of 500 or even 1,000 petahash. And this is agreed upon by the two counterparties and is usually dependent on the needs of the miner. Now, the last component is the duration of the trade. So again, typically these contracts are in 30-day increments, but they can easily be customized to any time frame, be it shorter or longer. So to facilitate these trades, Luxor provides several key services. We facilitate price discovery, meaning we help counterparties find liquidity at the prices that they're looking for. We help customers manage their counterparty risk, as we are the only person that counterparties will engage with. So when you trade these instruments, your only counterparty risk is us. We act as a settlement agent. So as the contract is settled to our hash price index, we also do our own methodology for calculating the settlement. And then we also handle the reporting requirements that are mandated by the CFTC for OTC transactions. We're also building several tools to aid our customers with their trading needs. We have a hedging calculator, which I plan to show in a few minutes. And we're also launching a derivatives UI, a front end that helps our customers manage their positions, see daily profit and loss, and also manage other key components of their trades. Before we get to the hedging calculator, though, I want to walk through a simple hedging example from a miner's perspective. So in this example, let's assume we have a miner who has 50 petahash and is very concerned about a downward move in Bitcoin price or a large positive move in network difficulty, or maybe both. So for these reasons, the miner wants to hedge their entire exposure to hash price for the next 30 days. Since hash price is a function of Bitcoin price and difficulty, as well as block rewards and transaction fees, using Luxor's Hashprice NDF will completely hedge their revenue exposure. However, it is important to note that Luxor's Hashprice NDF does not hedge the miner's power cost exposure in this scenario, and the miner may opt to hedge this risk with other energy derivatives. Now, to hedge their hash price exposure, this miner decides they want to sell the equivalent of their petahash and times the amount of days they want to hedge, which in this case is 50 petahash for 30 days and equates to 1,500 contracts at a hash price of $90 in the example. So the miner goes about doing their normal mining operations. They're hedged 50 petahash at $90. And at the expiration, the miner realizes a settlement of $70 because hash price went way down. So in that scenario, they receive a profit of $30,000 from the NDF that effectively offsets the adverse price movement that they saw in hash price. So the miner in this example has locked in $90 hash price for 30 days and guaranteed the revenue they will receive for that hash price. For that hash rate. So had they not hedged, they would have missed out on that additional revenue. And then, like I said, if you want to walk through a scenario like this around your own operation, you can check out our hedging calculator, which is on our website. So the hedging calculator is designed just to be a simple tool for miners to run through scenario-based results on potential hedging strategies. So there's several inputs. Users can input the amount of hash rate they own, and want to hedge in percentage terms, they can input their electricity usage and cost, the hash price at which they want to hedge or they think they can hedge, and then also the duration of the contract. The scenario slider on the right of this shows the hypothetical settlement scenarios based on the percentage moves in the underlying hash price. So if hash price goes up 10% or 25% or down, you can see where your profit and loss would be affected. Now I'd like to talk you through another use case for these derivatives. So we often get asked who will be on the other side of this market. In fact, it's probably one of the #1 questions we get. So as the Hashprice NDF is designed to be a true hedging instrument for miners, there would logically be more sellers than buyers, as the hedgers are the sellers. So to ensure we have a diverse set of participants in this market, we've spent a lot of time validating that there would be buy-side liquidity. So we've talked to everyone in the space we can think of, and also in the TradFi world as well. And we're very confident that our buy-side participants, including the people we've onboarded, will include crypto market makers, crypto hedge funds, private equity, proprietary trading groups, as well as others that are simply looking to get long exposure to hash price. Our Hashprice NDF acts as a great diversifier to Bitcoin exposure, or for those looking to manage exposure to difficulty. Another interesting use case we come across quite a bit are people looking to get synthetic exposure to hash rate and hash price. So this could be a miner looking to procure ASICs, might be waiting out ASIC prices, or they're having trouble finding hosting, and they want to have temporary exposure to hash price while they get online. This would be a great instrument to provide that temporary exposure. And also from a long exposure, as we see this example in this slide, this instrument is as simple as buying the NDF at an agreed upon price, size, and duration. So in this example, it's again 50 petahash at $70 for 30 days. And then at the end of the contract, they would receive or possibly pay a cash settlement based on the settlement rate at the end of the contract. So in this example, the investor bought or went long hash price at a price of 70, and the contract settled at 90, netting the investor $20 per unit price, which again equates to a $30,000 profit. So the key differentiator here is it's important to understand that you do not need to own hash rate in order to trade these NDFs. Regardless if you're buying or selling, this can be a tool for exposure or to manage your risk. Okay, so there's lots of benefits to this instrument. The Hashprice NDF is designed to be an effective instrument for miners, hosting facilities, lenders, and financiers. But it's also designed to be an instrument to give investors and market makers exposure to movements in hash price without needing the physical equipment. The other benefits that can be seen is, it's miner-specific hedging, meaning miners can hedge their revenue across the 4 components that go into hash price, so Bitcoin price, difficulty, transaction fees, and using a single product to do that, which could be very effective. Our settlement process is super simple and quick. So for ease of use, the contracts are settled in cash. There's no component of physical delivery to worry about. Traders don't have to worry about downtime, curtailment, or custody of Bitcoin. None of that exists in this trade. These trades are also highly customizable, so they can be tailored to a miner or colo or a hosting site's specific needs, as well as those looking to get exposure on the long side. And the NDFs also provide for unique optionality. So they give the non-physical exposure for those looking to procure hash rate, but dealing with long lead times. And purchasing these NDFs can get them that temporary exposure. And lastly, they're a great tool for diversification. So especially those that are looking to get exposure into this space, which can be seen as an emerging alternative asset class. So we've launched, in conjunction with this, we've launched a derivatives blog as well, and we'll be releasing content to the blog every other week. I think we had our first one 2 weeks ago. We plan to cover hash price, market commentary, hedging strategies, industry news, and much more. So if you'd like to subscribe to this, please follow the URL on the screen. And from there, let's field some questions. Okay, so the first question I got is, do you collect initial margin for this? So in the OTC space, for those that aren't familiar, initial margins are an important component of these kind of trades. And it's effectively, you can think of it as collateral for these trades. So yes, the answer is yes. We calculate notional value of the trade, which will be the size times the price times the duration, and to get you to a dollar value. And then we require a 30%. We require a 30% margin before the start of the trade, and then that's financially settled at the end of the contract. We're also working on other avenues to help mitigate counterparty risk for everyone. Let's see. Okay, next question is, what are the regulatory requirements for this? So there's a fair amount of requirements that came out of Dodd-Frank, I believe in 2013, one of which is called the ISDA Master Agreement. So the ISDA Master Agreement is a lengthy legal document that can be thought of as a standard agreement that's commonly implemented to govern these types of trades. It's a template, and there's a number of documents that go with it, one of which is the Credit Support Annex. So the Credit Support Annex defines the terms that we just talked about with margin. And both of these documents kind of describe how participants should behave from a legal perspective with regard to each other when they're trading these contracts. It can be a bit of a slight burden in the beginning to get through these, but it's a one-time thing. Counterparties will agree with each other on these documents. Once they're executed, it's done, and you can move on to your trading. Oh, there's also one more piece. So the CFTC requires that one of the parties reports these trades once they're executed. We take that burden on ourselves. We handle all the trade reporting requirements, and we've integrated with what's called a swap data repository. The company is called Core Financial, and we do all that. So whoever trades with us does not have to worry about that burden either. All right, it looks like I got another one coming in. Is your NDF live? So yes, our contract is live. We launched on October 10th. We've been onboarding customers for the past several months. Those that are onboarded with us and sign these ISDA agreements will get access to the prices. So my team will post prices intraday. Several times a day, we'll show what the prices are, match counterparty trades, and we've made trades already since launch. So yes, definitely live. All right, in respect to that same question, we get a question that said, will the order book be public so that we can watch price discovery? So right now, no, the order book is not public. We only interact with each of the counterparties. And so we aggregate bids and offers and depth, and we start providing the top of the book, meaning the best bid and the best offer to the interested counterparties. Okay, another question. How do these contracts work when a mine goes offline while a contract is active? Say a difficulty or curtailment forces a miner offline for long days, day-long stretches. So these contracts are completely sorry, I heard these contracts are completely not tied to the physical component. So everything is settled in cash. You can think of these as completely separate from a physical operation. So if a mine goes offline while the contract is live, it has no bearing on the cash settlement of this, as the counterparties agree to a price, size, and duration, and that's all settled in cash. Okay, I believe that is all the questions that we have for right now. We could give it another minute and see if any others pop in. Okay, we got another one. So can we settle the contract with BTC or stablecoin? So short answer is no. We are settling the contract in USD. The long answer is yes. We are planning to be able to do stablecoins or BTC and that'll be part phase 2 of this launch. All right, another question. How do you determine the dollar value of Bitcoin? Is there a risk that, so the dollar value of Bitcoin in our index is a component of it's a component of a number of different constituent exchanges. So we do a dollar volume weighted average based off of spot exchanges. And so that goes into the calculation of our methodology. But if the follow-up question to that, is there a risk that a flash crash of Bitcoin can create a scenario where contracts are forced liquidate? We don't do forced liquidation in these contracts. All the contracts are settled at the end of the contract. Hash price. How is hash price calculated? So hash price is calculated by the 4 main components that I mentioned before. You can think of it as a similar methodology to a full price per share of a mining pool. So we take the methodology includes block subsidy, transaction fees, network difficulty, and Bitcoin price, and produces the petahash per second per day value that you see on our index. Wow, there's a lot of questions. This is great. So the next question, who manages the collateral? We manage the collateral. So we have a segregated account where when we collect that 30%, it goes into the account and sits there for the duration of the contract. And then you get paid back the difference at the settlement time. Okay. Will Luxor continue to offer webinars like this to help understand how they can use this product best? Yes, absolutely. We were actually just talking about that before this. We plan to do regular webinars, focus on this instrument, market commentary. We're working on a blog post as we speak that kind of outlines hedging 101 and going over some different hedging scenarios. So yeah, our goal in all of this is to be as educational as possible and help the community get up to speed on how these derivatives can help their operations. What is the longest duration the contract will be offered? We haven't got to that yet. We're not setting limits at the moment. I would think naturally due to different aspects of Bitcoin volatility, these will go from anywhere from 30 days to 6 months, but they could be up to a year as well. We're going to let the market dictate how these work. I think there's also the potential to standardize these monthly contracts a bit more as an alternative to doing the bespoke. But yeah, right now we're kind of letting the market dictate in terms of the duration. We got a question about variation margins. So variation margin is an extension of the initial margin. So essentially, initial margin is the upfront collateral you collect, but if a trade goes wildly in a direction averse to your counterparty, there's a concept called variation margin where you would collect more money to manage your risk. For this is part of our phase 2. Yes, we plan to offer a variation margin, which also can effectively lower your initial margin requirements. But yeah, we're exploring that now, but we're not ready to go to market with it just yet. All right, we got a question that said, your presentation said hash rate was a continuously delivered commodity. Can you elaborate on the implications of this? This is a great question. So it definitely is a continuously delivered commodity. So hash rate is continuously producing store value in Bitcoin. And you can think about it, it's analogous to kind of like an electricity contract where you have to account for the continuous nature of that commodity. And the way that they do this in electricity contracts is they do, when they're working on the settlement rate, they do an averaging. So what we do is something similar. For the settlement rate, we'll take an average of all the price prints that occur during the duration of the contract. And that's how you manage the continuous nature of it. So rather than taking a settlement rate at the last minute of the end of the last day, we do an average over the whole duration of the contract. And that's how you account for that continuous nature. Okay, I think we have one more question. Will this derivatives product be available for miners all over the world? Yes, our intention is to support anyone that's not part of an OFAC country. And we're actively working on to make this as widely as acceptable as possible. All right, I think we got one more that I'm going to answer. Is it possible to place test trades to learn how the product works without actual dollars? So I would encourage whoever asked that to reach out to us. We're happy to get on calls and discuss how the product works. And in many scenarios, we've done test trades with other people to get them comfortable with this. So please reach out to us, and we're happy to take that. Okay, I think that's it for the questions. I do want to thank everyone for your time. This has been great. I hope you got as much out of it as we anticipated. And please reach out to us with any further questions. If you want to have a discussion, if you'd like to talk to us about how to onboard, more than happy to answer any of those questions. So thank you for your time.